Are you planning to give money to charity in the next couple of years? You need to pay attention. The new big beautiful tax bill changed the rules. How much you give, when you give, and even who you give can change the size of your tax break. If you want your generosity to actually save you money on taxes, you got to understand what's different in 2025 versus 2026. Otherwise, you could end up giving the same amount but keeping fewer dollars in your pocket. So let's break it down in plain English, and I will give you real example and planning tips so you can make the smartest move. Hi, I'm Mia. I'm a tax professional with more than 15 years of experience, and I have family and small business owner and landlords save money on their taxes and file with confidence. Here's the baseline. Before the new bill, if you make cash donation to public charities, you could deduct up to 60% of your adjusted gross income. So if your AGI was $500,000, the maximum deduction you could take in 1 year was $300,000. Anything above that carried forward for up to 5 years. That rule came from the 2017 Tax Cut and Jobs Act, but it was scheduled to expire. Donors weren't sure what would happen after 2025. The new law signed in July 2025 make a few big changes you need to know about. So first, the 60% AGI limit is now permanent. It's not going back down to 50% like before. Second, starting in 2026, there's a new 0.5% AGI floor. That means the first 0.5% of your income that you give isn't deductible. For example, if you make $500,000, the first $2,500 gifts won't count as a deduction. Third, also in 2026, if you are in the top tax bracket, the value of your deductions is capped at 35 cents for every dollar instead of 37 cents. That's a quiet haircut on the value of your giving. Fourth, non-itemizer get something back starting in 2026. There is an above the line deduction of up to $1,000 for single or $2,000 for married couple filing jointly. But it only applies to cash gifts. So if you donate something into like Goodwill or something, your extra clothes or appliances, that's not going to apply. So of course you cannot use it for donor advised fund or supporting organizations. Fifth, corporate donors now pay a 1% income floor starting in 2026. The 10% ceiling remains, but the first line of giving is no longer deductible. And finally, in 2025 only, the SOL cap is higher at $40,000. That could make it easier for some high-income taxpayers to itemize this year and capture their charitable deduction more fully. Why does all of this matter? Because when and how you give can literally change how much tax you save. In 2025, you can still deduct from the first dollar you give. In 2026, that changed. The 0.5% floor kicks in. So if you give the same amount in both years, your deduction in 2026 will be smaller, right? Reduced by that floor. Like think about like in insurance, you have deductible that's out of your pocket before the insurance kicks in. So this works in similar concept. And if you are in the top tax bracket, every dollar you deduct is worth 35 cents instead of 37 cents. That's like a built-in 5% discount from your tax saving. So timing matters. Let me show you how this plays out. So let's look at example number one. A couple with $500,000 AGI in 2025. They decide to give $300,000 in cash to charity. In 2025, they can deduct the full $300,000 because that's exactly 60% of their AGI. Now, the same couple in 2026, they give the same amount, $30,000 again, the deduction is still capped at 60%, so capped at 300 grand, but the new 0.5 floor means that the first 2,500 doesn't count, so the deduction is effectively $2,970,500. And if they are in the top tax bracket, the tax value of that deduction is capped at 35%. So they save less tax even though they gave the exact same amount. Let's look at example number 2. It's a bunching with a donor advised fund. Let's say this couple usually give $100,000 per year for 3 years. So option A, so $100,000 in 2025, 26, 27. Option B, put $300,000 into a donor advised fund in 2025, get the full deduction in the better tax year, and then spread out the grants to charity over 2025, 26, and 27. So option B, lock in a bigger deduction and maximize tax saving while still supporting charity each year. Here's where the planning comes in. If you know you are going to give, consider bunching larger gifts in 2025. The rules are more favorable this year, no floor, full value deduction, and a bigger SOC cap that might push you over the threshold to itemize. Use a donor advised fund if you want to keep flexibility or when the charity actually gives the money. You get the deduction in 2025, but you can recommend grants later. If you are over age 70 and a half, don't forget about qualified charitable distributions from your IRA. These don't count as income. They reduce your AGI and they are not affected by the new 0.5 floor in 2026. The QCD limit in 2025 is about $108,000 per person. That's a huge tool if you are charitably inclined and already tech require minimum distributions. Starting in 2026, you need to adjust. If you itemize, try to group donations so you are clearly above the 0.5% floor. For example, instead of giving $5,000 a year on a $500,000 AGI, consider giving $15,000 every 3 years. That's way more of your giving is deductible. If you don't itemize, use the new above the line deduction. It's not huge, $1,000 or $2,000, but that's something, right? Just remember it doesn't apply to donor advised fund or supporting organization. If you are on the top bracket, recognize that every dollar you give now is worth 35 cents and tax saving not 37. This makes timing even more important. So pair charitable giving with other moves, selling appreciated stock in a high income year. Offset those gains with a big charitable gift. Planning for estate taxes, larger lifetime gift now can lower your estate and give you a deduction while you are alive. If you would like to run the number for yourself, I have built simple template and a charitable deduction calculator at Pro Deductions shop on Etsy. They will help you see the difference between 2025 and 2026 or what bunching into a donor advised fund would look like. And if you want deeper education on charitable planning, taxes, and estate strategy, visit Asset Y Institute. Here are a few extra angles most people miss. Don't overlook state tax rules. Some states don't follow federal changes exactly, so check if your state limit deduction differently. Document your gifts carefully. Cash donation over $250 require written acknowledgement. If you are giving appreciated stock, you need brokerage statement. Charitable giving can interact with alternative minimum tax AMT or net investment income tax or even phase out of other deduction. So running the number can reveal surprises. If you are a business owner, think about corporate versus personal giving. With the new 1% floor for corporate deductions, it might make more sense to give personally or vice versa, depending on your income mix. Now, I would love to hear from you. If you usually spread your gift evenly every year, or do you bunch them into a single year to maximize your deduction? Type small or bunch in the comments. I want to see what more of you are doing. If this breakdown was helpful, please subscribe, like, and share this video. I will keep covering the big beautiful tax bill changes in plain language so you can make smart moves with your money. And don't forget to check the link in the description or templates and resources. I'm Mia, thanks for watching, and I will see you in the next one. Mahalo!